Hello everyone, welcome back to Financial News. Today is May 8th, 2023. I'm Ron Jankowski with Channel 4. My co-host, Paul Municle with Ameriprise Financial. Paul, lots of things have happened. I think there was a change in interest rates. I'm going to let you take it and get us up to date.
Thanks, Ron. Today I'm going to talk about what earnings recession, because just excluding just the semiconductor industry, Q1 earnings per share would be flat year over year. Now, in aggregate, Q1 earnings results are coming in better than expected. Currently, with 85% of S&P 500 companies having reported earnings per share, for the index are seen being down just 2.4% versus year-ago levels on sales growth of positive 3.9%. Now, just last week, actual results combined with estimates looked for Q1 earnings per share to be down 3.3% on sales growth of positive 3.3%. At quarter's end, which was April 1st, analysts had forecasted an earnings per share decline of 6.1% on sales growth of just a positive 2%. Additionally, 79% of reporting companies have shown better than expected earnings versus a 5-year average of 77%, while 75% have beat revenue expectations. Inflation is a prime factor behind the quarter's lower profit growth. However, this year's strong U.S. dollar has also shown itself to be a key source of pressure affecting both sales and earnings. Now, according to FactSet, companies with 50% or more of their sales in the U.S. are reporting year-over-year earnings per share growth of positive 2.7% on average, while companies with 50% or more of their sales outside of the U.S. have shown an average earnings per share decline of 10.2%. Now, the technology sector is also offering the most drag on results for the period, with lower earnings from the semiconductor industry currently accounting for 2.5 percentage points of drag on overall S&P 500 earnings per share results. So in other words, excluding just this one industry, S&P 500 earnings would be 0.1% higher than year-ago levels, while sales would be 4.3% higher. So some interesting data there, and more that we will examine as it comes.
And as of this morning, Ameriprise had shared this information with us. The U.S. stock index futures are mostly higher this morning following a strong rally on Friday. And it was.
That rally
Boy, we sure did.
It was a rough week, and Friday's rally came in.
Sure came in nicely. Markets in Asia closed mixed with Japan at minus 0.6%, to Shanghai at plus 1.7%. And Europe is mostly higher. UK closed for the coronation of the King Charles III. So activity there had just pretty much stopped. Treasury yields are higher, with the 2-year back near 4%, the 10-year nearing 3.5%. Bitcoin is down 4% this morning. Gold is up 0.3%. WTI crude is up 1.8% after losing 7% last week.
It's a big move in oil.
It is a big move. Talking about interest rates, there was an increase last week.
1/4 point, as expected, yeah.
As expected. I hear that this might be the end.
We'll see.
You hear and what they do are two different things.
There's a lot of data that they'll analyze and decide.
Boy, unbelievable. Unbelievable that you don't really know where this is all going to go. The index year-to-date returns are S&P 500 is a plus 8%, Dow Jones a plus 2%, NASDAQ a plus 17%. NASDAQ is holding pretty firm, and the Dow Jones lost a little.
Yeah, still all in the positive, which is
still
good.
solid though, relatively speaking. Yeah.
Right.
Okay. Well, thank you, Paul, for the update for Paul Munical and myself, Ron Jankowski, we're going to ask you to stay with us for our other show called Your Money. Paul usually has an interesting topic to cover. Stay with us. We'll be right back. Thank you for staying with us at our show called Your Money. And Paul has an interesting topic called 5 Myths About Retirement That Can Lead You Astray. Paul, set us straight.
Thanks, Ron. Whether you are decades away from retirement or it's right around the corner, it's important to separate fact from fiction when it comes to planning for your post-work life. So today we're going to go over 5 common and often costly myths that often mislead people about life in retirement. Keeping them in mind can help you avoid missteps and hopefully achieve your goals for a happy and satisfying retirement. So let's go right into it. Myth number 1, retirement life will be less expensive. Retirement often frees up more time to pursue other interests and hobbies, and this may include more travel, social activities, and other pursuits that require a financial commitment. Now, depending on your goals, be prepared for life in retirement to cost maybe more than you might think. In particular, be cognizant that many people overestimate how much money they'll save by quote-unquote downsizing their homes. While they may save on property taxes and utilities, they may encounter new costs related to their new, smaller living arrangements, such as homeowner association and facility fees. Myth number 2, health insurance is simple and free. Definitely a myth. Medicare is a critical benefit for retirees, but it wasn't designed to cover everything. Medicare involves a complex combination of various policies, and full coverage comes with costs. Medicare Part A, the basic coverage for hospital insurance, is free for most Americans over the age of 65. Now that said, other forms of Medicare have costs associated with coverage. According to Medicare.gov, in 2023, the standard premium for Medicare Part B for physician services is $164.90 per month. Medicare Part D for prescription drug coverage also involves monthly premiums. Most retirees will pay premiums for supplemental health coverage or choose a Medicare Advantage plan to protect them. Copays and deductibles can be included, so plan on health care as a major expense in your retirement. Myth number 3, Social Security will take care of my financial needs in retirement. Definitely a myth as well. According to the Social Security Administration, more than 1/3 of Americans rely on Social Security for more than half of their income in retirement. Now that said, it's important to be realistic. The average Social Security benefit for retired workers in January of 2023 is $1,827 per month. Even if you double that for a married couple, it's likely to be far less than your pre-retirement income and far from enough to meet your needs in retirement. That's why saving in a workplace retirement plan, such as IRAs and other types of investment vehicles, is critical to protect your long-term financial security. Moving along to myth number 4, taxes won't be a major concern in retirement. Now, you might think that because you aren't working, taxes don't come into play. The reality is far from different. Most people are required to pay taxes on a portion of their Social Security income. What's more, Distributions from workplace savings plans such as 401ks or 403bs and traditional IRAs are generally subject to income taxes as well. Most income generated by bonds, bond funds, and CDs are taxable. You may even need to make quarterly estimated tax payments on your investment income and retirement plan distributions. And moving along and finishing off, myth number 5, retirement will mean it's time to relax and kick back. Given the longer life expectancies that many Americans enjoy today, the reality is that leaving your position with a company or ending a career doesn't necessarily mean you are done with work. Many people have the desire to remain active. This can take the form of consulting, using talents and experience you have to continue to earn money. It also might mean spending significant time volunteering for organizations you support. In short, retirement doesn't mean setting your talents, abilities, and energies aside. For many, it's the start of a new chapter in life. And of course, planning helps you stay reality-based. As you structure your retirement plan, it makes sense to put some thought into what life will look like and how that might impact your living costs. A good plan will help you set these myths aside and deal with the real world of retirement.
I wanted to mention something, Paul. You were talking about downsizing. You could have a large home and want to downsize, and that downsize is not going to actually reduce your cost. With the housing market fluctuating the way it is, you could end up equal or maybe even more in debt.
You don't know, and you don't know the expenses, of course. Well, you will know, but the expenses on the new home, like I had mentioned, if you get a condo or a townhome, could have HOA fees that are pretty significant.
Yeah,
so
exactly.
it's not just a no-brainer. You need to, of course, take your time and examine the numbers before you take any action on any kind of significant move.
Great suggestion. Yeah, great guidance on this whole thing that you talked about. Thank you, Paul. For Paul Municle with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you a good investment day.
And I did want to mention, Ron, before we exit, that if anyone does have questions on this topic or any others,
insert that.
Yeah, feel free to give me a call directly at 708-226-3412.
Okay, thanks, Paul, for coming in with that information for the viewers. We will see you again next week.